what he was doing, Jay Powell hadn't raised rates to this extent, where do you think inflation would be? Because all of this spending that was already baked in.
I believe it would have gone down on its own.
Okay, why?
That's because the money was being worn out and it was driven by a lack of supply on the shelves. I don't think he needed to do this. Maybe 300 basis points,
But
not
he's
500.
he's also battling a lot of fiscal spending.
Well, if you bring up the next slide, you'll see that what's happened since he started raising rates in the healthcare industry, which is completely insensitive to interest rates. You've added 3.2 million jobs in healthcare since May of 22. So he's had zero impact. 3.2 million positive jobs since May of 22 in healthcare. So obviously that's like, and you still have a nursing shortage. You're going to have more inflation, more people looking for jobs. The report this morning, the ADP report, showed there was another second category. Go to the next slide. This is the one that's completely shocking, which is construction. And this is where spending comes in.
Right.
It looks just like healthcare. We've added 1 million jobs in construction. You lost 1 million jobs in 07, 08 in construction. We've added them, even though he's increased interest rates 500 basis points. Why? Data centers, the transportation bill, the CHIPS Act, the infrastructure bill. So he's not getting layoffs in the part of the market that are most sensitive. This is the most sensitive employment category to interest rates, and it's going the wrong way. So his toolbox is not working. And
basically, he can't do it. It doesn't matter.
He can't do it. Or he has to go after services, which is retail, lodging, hospitality, business trade. If he hits that, he creates a great recession. If he's going to knock those jobs out, which is a big category, he's going to have a serious consumer recession, which I don't think he can stop. And that's when he's going to have to get aggressive on rate cuts. So and the consequence of this is not small. The consequence is the federal government, and I think it was the last thing I had, is the biggest victim because Rick Reeder is a guest of you all the time, right? He'll argue that high rates are creating inflation from BlackRock, right? He thinks that the excess, we're making $235 billion of excess interest income today. It used to be 70 billion consumers got when T-bills were low. Now it's 318 billion. 235 billion of excess interest income is going out and buying things like services. He'd argue that the show used to be $100 and now it's $300, right? Goods are going down, services are going up because consumers have excess cash from the savings they're getting, the interest income they're getting from all the cash they have in T-bills. So he's arguing that high interest rates are creating more inflation. So I think it's pretty interesting to see, and the government will spend, as you know, interest expense just passed defense spending,
right.
And it's on its way 1/3 of our debt. So he can spend 4% on 13 trillion or 5% on 13 trillion. That's the interest expense on the amount of the debt rolling just this year. Half our debt will roll in the next 3 years. So that's number one. The federal government's the biggest victim of his own problems.
Here's my argument with Powell is that he can only do so many things. He has two mandates. One is the inflation rate, the other is unemployment. Those are the two things he's supposed to be watching. You're right that he has a limited toolbox in what he can do.
Very limited.
I don't know that this is a fault of Jay Powell and the Fed, or if this is just, there's only so much they can do and there are all these other forces that are adding up.
It's a tough job. And with Congress spending money the way they are.
That would be my...
It's not, again, one arm of the government has their foot on the accelerator and the other on the brake.
Yeah.
And usually things explode when that happens. The engine wears out. I hope it doesn't explode. I mean, the U.S. economy is being powered with productivity. A lot of jobs are part-time. They're not full-time. But I think he just has to be careful. And I think because of the housing market with 4 or 5 million home deficit, and that is the biggest component of CPI, this deficit that he's making ever bigger because housing starts are falling and we're not building as many units will show up in a couple of years with higher rent growth than he ought to have. He ought to smooth it out, lower rates, increase construction. But, it's a tough thing. And then you have the regional banks. And don't forget, that's the second biggest victim here.
Yeah, one of the things people have said is that the economy is really good right now. The markets are really strong. The only thing that would cause the Fed to actually cut rates at this point might be if there's something that breaks.
I think there's
the
two
regional
reasons.
banks come into that.
It's the regional banks and the commercial real estate crisis that's coming, which is coming. I mean, you can see it. We don't talk about the office. The amount of non-performing loans coming to market is growing. And he's also impacted the whole world. We're seeing, distress across Europe because heretofore they've had to go rates went up with ours.
Yeah.
They're going to lower rates.
For the first time ever in the euro, since the euro's been created, that they would lead us in rate cuts.
They don't have They don't have the CHIPS Act, the infrastructure bill. They don't have those bills that are powering our economy past theirs. And AI is, the data center business in the United States is insane, and they can't play. They don't have gas, they don't have oil, and they don't have excess power. So the differential between the U.S. economy and our growth and Europe's is going to accelerate because of all the impacts in the coming decades of AI on commercial profit margins.
There you have it, ladies and gentlemen. That was Barry Sternlicht. He's a real estate billionaire, and he's making the point that I made a while back, and I'm starting to hear more of these talking heads make that similar point, which is that these higher rates are not causing a recession. They will not cause a recession. And the reason that is because we are not in a situation where there's massive amounts of debt in the system. The only entity that is a victim of these higher rates is the government itself. So, who's on the other side? Who's the beneficiary of the government going into debt? It is the U.S. economy, in fact, that is the beneficiary of the government going into debt. Because the government going into debt, who are they going into debt to? They're going into debt to us, the American people who are buying the debt, and we are the ones, the beneficiaries, receiving all that massive amounts of income that is flooding into the system. So like he said, there's $235 billion of excess income coming into the market. I believe that's every year. So this is extra money that is fueling the inflation, you could argue, into the services industries, restaurants, theaters, shows, concerts. I mean, look at the price of going to a Taylor Swift concert. It's outrageous. It's insane. Thousands of dollars for just regular seats. So this is where people are going to spend that excess money. You're not necessarily going to go buy another mansion, another house, another yacht, but you might spend more time going out to restaurants, more time going out to shows. So how does that look? How does this $235 billion actually manifest into the market? This is what it looks like. Let's say you're a regular boomer in America, which is like half the American population now. So if you're a boomer in America, you might have, let's say, $1 million, $2 million, 800,000 in your investment account. Now, let's say you have $1 million in your investment account. Let's say 200,000 is sitting in cash in your investment account. Well, that $200,000 at 0% interest rates, at 1% interest rates, was making you very little income. Okay, so if I have 200,000 sitting in my cash account, right now, before we raised interest rates, you're a boomer. You're not a young person. You're a boomer. You got money. You're loaded. All that. You got 200,000. Beforehand, you were making 1% on that 200,000. You're making $2,000 a year off of that 200 grand every year. Divided by 12 months, that's an extra $160 a month. That's nothing, right? But now, if you're making 5%, 5.5%, let's say you're making 5% times 0.0, boom, you're making $10,000 a year now off of that same 200 grand. So divided by 12, that's like $850 a month in extra money. So before you were getting 160, now you're getting 800. That's a couple more nights out at the restaurant. That's a couple more nights out at the show, the theater. So this is what he was arguing. This is what I've been arguing. And another way you can look at this is, I had a chart. I don't know where it is, but this was from Josh Brown. Shout out to Josh Brown for being on CNBC, also touting this point, and also on his show, The Compound and Friends. And he makes this same point, which is that these higher rates are actually fueling the economy. It's not going to cause a recession. It is fueling the economy. It's the government that is getting hurt because they're going deeper in debt, which eventually will hurt us in the long run, but we're not there yet. So, he has this chart, and he showed the debt of all these companies and how much debt we had, compared to like 2008 and things like that. And in the chart, we have less debt on a nominal number, so an actual nominal amount, than we did back in 2008, talking about S&P 500 companies. So the S&P 500 as a total has less debt today, slightly less than what they did in 2008. So now think about that for a second, because in 2008, what was the stock market? What was the entire value of the stock market? It was way less than what it is today. So as a percentage basis, you can see how we are way more prudent than before when it comes to S&P 500, when it comes to households. There's way less debt in the system. The system is way less leveraged. The only entity that is extremely leveraged at this point is the government. But we, on the other side, are the beneficiaries. So when you're the Federal Reserve and you're in this situation and you raise interest rates, are you going to hurt the economy? No, because the economy doesn't have much debt that needs to be rolled over at those higher rates. That's going to put pressure as an expense on the balance sheet and on earnings and going to hurt our earnings. No, we're not in that situation like in 2008. Okay? We're in this weird situation where companies, S&P 500, other companies, smaller households have way less debt. So if I have no debt and you raise interest rates from 1% to 5%, and I'm a boomer, I already own a house, I don't care. I'm literally just going to make 5% now on my money market fund, right? Because my money market fund is investing in the US debt. That's how they pay you the 5%. So this is the weird situation we're in that's different from previous cycles, previous bubbles, whatever you want to call it. So this point, I believe, that Barry is making is going to get more and more into the mainstream narrative as interest rates are staying high and there is no recession in sight. Okay? But he does make the point that the regional banks, the banks, are the ones that are going to be hurt. But it's a weird situation because if I'm a regional bank and I have all this debt, I bought all these loans, right? This debt from the government, and let's say I got it at 1%, 2%. I'm only making 1%, 2%, but but I'm making payments now at like 4%, 5%, right? To savings accounts. You're negative there. But that's kind of being offset by the fact that the economy is growing, so there's more money coming into the banks themselves. So it's a weird situation. You're going to have some banks that are going to be hurt here and there, regional banks, but it's not going to be a massive problem because the person in debt in this situation is different from every other entity that goes in debt. You see, every other entity that goes in debt has to either get more debt to pay their previous debt, their obligations, or they go bankrupt. But the government is a weird entity where they have this secret thing called the Federal Reserve, which is this secret bank that gets to just kind of print money, but it's not printing money, but it really is printing money. So they throw it on the back of you and me eventually through inflation because they're not going to go insolvent. They're not going to go bankrupt. That'll destroy the whole planet. And if they roll the debt, but nobody wants to buy it, guess what? They always have the Fed who's willing to buy. But when the Fed buys the debt, that's when it hits us on CPI and inflation. So that's how we're going to pay for this whole situation. If you're wondering, like, well, how does this all like collapse? You know, it doesn't really collapse. We just go further closer to more inflation. But we're still so far away from hyperinflation. So, and when you combine in the GDP and the growth of the economy, it even makes it harder for the case of hyperinflation. So that's why you're in this weird situation where the Fed has high rates, but we're not seeing a recession. The stock market keeps going up, doesn't stop, cannot quit. And you're like, what's going on here? Well, this is what's happening. The system is not over leveraged. The people do not have massive amounts of debt. They learned their lesson from 2008. We have such a scar from 2008 of all the leverage, all the debt, all the people having multiple houses, that we've consolidated all those traumas, and now we're no longer at that point of such debt. But the government has all the debt. And we're the beneficiaries. We're the ones getting all the income now. So that's the weird situation we're in. Let's see, I had a couple more quotes. So, I mean, pretty much saying what I've already said, which is that the federal government is the biggest victim of high rates. Fed toolbox is not working. Inflation would have gone down on its own. So this is another point, because she asked, like, well, if they didn't raise the interest rates, then inflation would still be so high. And Barry says, no, it probably would not have been. We don't know for sure, but why would it have stayed up? There's no reason it would have stayed high. It would have naturally came back down, because if I pour chlorine into the pool, and the chlorine is the Fed buying into debt, right? Pushing money into the system, flooding the system with new money. If I'm a piece of water over here in the pool and the chlorine comes in, oh my gosh, there's so much chlorine now. So that's the inflation going up. But if I stop pouring the chlorine over here, just simply by stopping pouring the chlorine, eventually all the chlorine is going to get perfectly diluted in the pool. So eventually all the money is going to get perfectly diluted. You're not going to keep seeing inflation climb up. You're not going to keep seeing chlorine pour into the system if I stop pouring the chlorine into the pool over here. And when the Fed simply stopped buying the debt, that was them stopping putting the chlorine. That was them stopping the inflation. It's just a matter of how long does it take for the chlorine to settle everywhere evenly. So how long does it take for the money that the Fed put into the system to evenly dispersed throughout the whole economy? So naturally, inflation would go down. So the Fed didn't really have to raise rates. But the argument for why they did, that is the strongman argument, not that argument, but if you were to argue it, is that you have to have higher rates in case there is an issue. You have a tool in your toolbox to cut. Okay, so that is the argument for why you would want higher interest rates. But the downside to that is, in this situation, it's the government that has all the debt now. So you're only hurting the government further, which is going to fuel inflation even further when the next crisis does in fact happen. So weird situation we're in, guys. All I can say is that find great companies, invest in great companies, and that's all I got for you. So if you thought this was interesting, check out my other video right up top, right up here, about Elon Musk moonshot plan that he might have in case he doesn't get his stock-based compensation package. Pretty interesting video that I got right there. Check that out. Drop a like on this video. Drop a comment. Make sure you get subscribed. Stay healthy. Stay wealthy. Stay tuned for the next one. Peace.